Pepsi stock is now trading almost at its lowest price in over 5 years. And if we look at the last year, they're now down 24.28%, and year to date, they have sold off by about 12%. Now, on the flip side of this, if we look at the dividend yield for this company, they now have the highest starting dividend yield in over 5 years. And if we look at the last 10 years, again, it's their highest starting dividend yield in over 10 years with a yield of around 4%. So the starting dividend yield has gone very high in the middle of this sell-off. Now, we need to address the news. What's going on? Well, this company recently released their latest quarter's earnings report, where they did report a beat on top lines. They beat revenue expectations by about $190 million, but revenue was still down about 1.8% year over year, and then they saw a miss on earnings. Q1 non-GAAP earnings per share of $1.48 was a miss by about 1 cent. Now we're going to dive into this earnings report and some other news a little bit more, but let's go ahead and get an understanding of this company from a dividend perspective right now. If we jump over to the dividend breakdown sheet and plug in Pepsi, all this data will load in thanks to the help of the Ticker Data add-on in Google Sheets. Like always, if you'd like to download any of these spreadsheets and also get access to that add-on that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now, like we already touched on, the starting dividend yield for Pepsi is now sitting above 4%, which has not happened for a very, very long time. So kind of a historic opportunity from the dividend perspective. But should we be enticed by that dividend? Well, there's actually a couple of red flags we see here. To start off, look at the 2024 free cash flow payout ratio. It's sitting at 100.56%. What does this mean? Well, it means the company had to use all of their free cash flow in order to pay out dividends. Now, there's 5 different things a company can do with free cash flow. They can reinvest back into the business, pay down debt, attempt mergers and acquisition, they can do share buybacks, and they can also pay out a dividend. So if you're using all your free cash flow to pay out dividends, it means it makes it really difficult to do all those other options, and sometimes you either have to use some of your cash position or take out debt. So 2024 free cash flow was about $7.1 billion, which was lower than it was in 2023, but dividends paid out was about $7.2 billion. This is not something we like to see. And in fact, if we look at this free cash flow payout ratio over time, we can see in 2014, it was sitting at a healthy 48%, but over the past decade, it has steadily climbed higher and higher. What does this mean? Well, it means that the dividends have been growing at a rate faster than free cash flow is growing. That is not a good sign. So even though the dividend growth rates at first glance do look good, the 10-year dividend CAGR at 7%, the 5-year dividend CAGR at 6%, this has been dividend growth that is not sustainable. So there's certainly some red flags on this sheet. But with that being said, if the company can find ways to grow free cash flow, they can turn things around and maintain that dividend and maintain the dividend growth. So what are they doing to make this happen, and does it look like moving forward that this will happen? Well, let's talk about guidance for a moment. Some of the worst news from this recent earnings report is they also cut guidance for 2025 amid global trade uncertainty. If we look at a quote from the CEO, he said, "Our business remained resilient in the midst of an increasingly dynamic and complex geopolitical and macroeconomic conditions in the first quarter. As we look ahead, we expect more volatility, not a word investors like to see, and uncertainty, again, another word investors don't like to see, particularly related to global trade developments, which we expect will increase our supply chain costs. At the same time, consumer conditions in many markets remain subdued and similarly have an uncertain outlook." Okay, so if you're an investor and you read this statement, especially if you're interested in lower volatility stocks like Pepsi, this is not what you like to see. So it's easy to see why the stock sold off after its recent earnings report. Management told us we can expect to see fiscal year 2025 low single-digit increase in organic revenue. So if we go ahead and jump over to our stock screener, let's look at the profitability sheet and come up here and plug in Pepsi. They told us we can expect low single-digit revenue growth. If we look at revenue in 2023, it was about $91.4 billion, and if we look at 2024, about $91.8 billion. So last year, revenue did grow, but it grew at a very slow rate, and they're basically telling us that's what we can expect moving forward. On top of this, Pepsi said it is actively planning mitigation actions to address higher supply chain costs where possible. Now, what's interesting about Pepsi is even though revenue growth has been relatively slow over the past 5 to 10 years, they actually have an impressively high gross profit ratio for the industry that they operate in, for the sector they operate in. If we look at last year's gross profit ratio, it is about 54.5%, and it's remained relatively stable over the past decade, which is typically a pretty good sign for a more mature business. But it'll be interesting to see what this looks like over the following years because obviously management has said they do have concerns about higher supply chain costs. So who knows, perhaps we'll see just how much pricing power Pepsi really has over the next year. The reason I say that is because they stated they want to minimize disruption to consumer and customer relationships. What does that mean? They don't want to make customers upset that they're increasing their prices. So again, will be interesting to see how this plays out. Now, in other recent news, RFK Jr. has stated he's set to phase out 8 widely used synthetic food dyes. And according to reports, the changes are expected to affect major food companies significantly, such as Pepsi. So while I do tend to be in the camp that this is probably a good thing for Americans in general, it's probably not a good thing for Pepsi. So all in all, recent news around this company has certainly not been good. I've seen a lot of investors getting excited about that high starting dividend yield and what they think is a buying opportunity, but this company certainly has some work to do. So we have to ask ourselves a few questions. Where does the future growth come from, and what does this valuation look like as of right now? Well, the company is growing earnings and revenue very slow because the reinvestment back into the business has not proven to be very profitable over the last few years. So what are they doing? What has management stated? Well, 2 earnings reports ago, they stated they're looking to make strategic acquisitions, and that's exactly what they've done over the last few months. Pepsi announced they're going to acquire the brand Poppi, which is a fast-growing prebiotic soda brand, so it's considered a healthier soda brand, which again, Pepsi management team has stated they want more exposure to items that are considered more healthy. All in all, there was a net purchase price of about $1.65 billion. Now that being said, Pepsi is certainly having to dig deep into their pockets to make acquisitions like this because, like we already saw, all of their free cash flow in 2024 was used to pay out dividends. So let's check out the balance sheet for this company. We'll come up here and plug in Pepsi. Now what we can see is the company has total assets of about $101 billion and total debt of about $48 billion. So the debt to assets ratio is sitting at 0.48. And if we look at the current ratio, it's sitting at just 0.83, meaning total current liabilities is higher than total current assets. Now, this is somewhat typical for Pepsi because the inventory on their items can move so quickly. So for example, we can see the current ratio has remained relatively low for the last few years, but again, the point is, it's not like they're sitting on a massive cash position. Total current assets have been pretty much unchanged for about 3 years in a row now. So with all this being said, what does the valuation look like for Pepsi right now? If we go ahead and jump over to our stock valuation sheet, let's come up here and plug in Pepsi. Now, before we move forward, the first thing I do want to point out is the beta for this company is very low, sitting at just 0.5. So typically, they'll see very low levels of price volatility, but just how much does that matter if the stock continues to sell off? Now, to start off, let's look at our discounted cash flow analysis for PepsiCo. And what we can see, assuming a free cash flow growth rate of 5%, which I'd actually argue is probably on the higher side than this company will actually see, we come to a DCF price per share of just $84.62, which is 36% lower than the current share price. Not a great sign to start. If we look at the historic multiple valuation, what we're doing is we're seeing how the market has historically valued this company versus how they're being valued right now. The average PE ratio over the last 10 years for this company is about 25.88. For the trailing 12 months, it's 19.57. So the stock is 24.4% cheaper than it has been over the past decade. But we have to remember, a PE ratio by itself doesn't give us enough information. If the underlying growth trajectory for this company moving forward has significantly lowered, then they do warrant a lower PE ratio. So I'd actually argue this can be a little bit deceiving in the case of Pepsi stock. Similarly, if we look at the multiples valuation, this can be a little bit deceiving as well because look at companies like Monster, a high PE ratio because they're growing earnings faster. Coca-Cola, the same is somewhat true. And so if we applied these same average PE ratios to Pepsi, they'd be worth about $233 per share. But they're simply not growing earnings fast enough to justify a multiples valuation here. If we move forward and look at our dividend discount model, we can see if we assume a 4.75% dividend growth rate and a discount rate of 8%, we do come to a fair value of $174.69, which is about 30% higher than that current share price. And if we look at those dividend growth rates historically, they have been able to achieve that dividend growth. But again, the huge concern here is, are they going to be able to grow dividends at a healthy rate moving forward with the free cash flow payout ratio above 100%? And the short answer is no. Free cash flow absolutely has to grow at a faster rate if they're going to be able to continue to grow those dividend payments over time. So even when we look at this dividend discount model, this is completely contingent on whether or not the company can actually grow their free cash flow at a healthier rate. If not, we can pretty much throw this valuation out the window. So with that being said, if we did take these three valuations together and average them together, we come to an intrinsic value of $164. But again, the multiples valuation in this scenario, with Pepsi stating it's really not going to be growing earnings at a high rate, this multiples valuation might not be justified anymore. And even if it was, we'd probably have to remove Monster Beverage Corporation from this valuation and only compare it to Coca-Cola since that's probably the most similar valuation. And in that case, the intrinsic value would jump down to about $152.93. With that being said, this valuation is about 12 to 13% higher than the current share price for this company. But again, I want to be completely clear. All of this is completely contingent on whether or not Pepsi can actually grow its free cash flow at a healthier rate in the future. If that free cash flow remains stagnant, the company will be in huge trouble. But even if they can continue to get single-digit free cash flow growth, then that dividend is probably safe, meaning all of a sudden, the company looks quite a bit more attractive with a starting dividend yield of about 4% and maybe a slower dividend growth rate. So as for me, this isn't a company I would add to my portfolio. I do think there's better opportunities out there, and I technically do have some exposure to this company through my ETF holding of SCHD. But go ahead and let me know what you think of PepsiCo in the comments down below if you plan on buying or selling. And like always, if you'd like to get access to any of my spreadsheets and also access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.